Hello everyone. In today's session, we are discussing about Financial Accounting 3, Program Commerce, Semester 3, University, Mangalore, Session 63. Recap of previous classes to make distinction between dissolution and sale of firm. Need for dissolution and sale of firm. Learning objectives to make them analyze the concept of purchase consideration and its calculation to prepare the students for accounting during dissolution and sale of partnership firm. Learning outcomes. Students are able to analyze the concepts related to dissolution of partnership firm. The students are able to prepare accounts on sale of firm. The topic in 63 is accounting procedure. The accounting procedure which deals with journal entries, preparation of realization account, transfers of reserves and surplus, and settlement of final capital. So if you refer the study material attached to this video, you can see there are 11 steps in preparing journal entries and accounts. So let us analyze the journal entries. The step 1, which meant for transferring of assets and liabilities to realization account. In this aspect, we have first the transfer of assets. So the assets have debit balance. In order to transfer, we have to credit. So therefore, the journal entry for transferring the assets is realization account debtor to sundry assets account. In transferring assets, generally it is assumed the cash is taken over. And when the cash or bank is taken over, we can even transfer the cash in bank. But when the cash or bank is not taken over, so we need not transfer the cash in bank to realization account while passing this journal entry. The second journal entry is for transferring the liabilities. To transfer the liabilities have credit balance. In order to transfer, we have to debit it. So the journal entry is sundry liabilities account debtor to realization account. So in the first step, we have transferred all the assets and liabilities to the realization account. In the next stage, as we mentioned in the session 62, we have calculated the purchase consideration. Such purchase consideration may be given in a lump sum method or we have to calculate in the net asset method. Once we calculate the purchase consideration, so we can pass the entry on the credit side of the realization account, and the journal entry for recording the purchase consideration is purchasing company's account debtor to realization account. And the step 3 in journal entry, assets not taken over by purchasing company. If any assets is not taken over by the purchasing company, there are following 3 methods which may arise in the problem. One is the sale of assets. When the assets are sold, the journal entry will be bank account debtor to realization account. The second one is the assets may be taken over by partners. When the assets taken over by the partners, the journal entry is partners capital account debtor to realization account. And the third is the sharing of assets by partners when it is not taken over either by the partners or sold by the firm. In case the journal entry is partners capital account debtor to realization account, such assets may be distributed in their capital ratio among the partners. Step 4 for journal entries, liabilities not taken over or unrecorded if any is discharged. So here we have 3 steps or journal entries. One is payment of liability. For this, you may pass the journal entry realization account debtor to bank account. Second one, if the liability is taken over by the partners, the entry is realization account debtor to partners capital account. Third is, if the liabilities are assumed by all the partners, in this case, the journal entry is realization account debtor to partner's capital account. So the amount distributed in the final capital ratio. Step 5 for journal entries, payment of realization expenses. The entry for payment of realization expenses is realization account debtor to bank account. Step 6, closing of realization account. So the realization account, after transferring all the assets and liabilities and payment of all the assets and liabilities, the account will be closed. The realization account may have profit or loss. If there is profit, the entry will be realization account debtor to partners capital account. So the profits are distributed in their profit sharing ratio. If there is losses, the journal entry is partners capital account debtor to realization account. Step 7, entry for receiving purchase consideration. So the purchase consideration may be received in the form of cash, equity shares, preference shares, or debentures. So the journal entry is cash or bank account debtor, equity shares in purchasing company account debtor, preference shares in purchasing company account debtor, debentures in purchasing company account debtor to purchasing company account. So that is a step 7 where we are making record for the consideration received by the purchasing company. Step 8 deals with reserves and surplus. The closing balance discloses any reserves and surplus available. Such reserves and profits has to be shared among the partners, and the entry is reserves account debtor, profit and loss account debtor to partners capital account. So these reserves and profits are transferred in their profit sharing ratio. Suppose in the problem if there is any loss, the loss should also be transferred to the partners. So the journal entry is partners capital account debtor to profit and loss account. Step 9 in journal entry. If the problem states about current account and partners fixed capital, in that circumstance, the current account has to be closed to partner's capital account. The journal entry will be partner's current account debtor to partner's capital account. Step 10, payment of partner's loan. If the partner's loan, if any, is there, it is settled first. The entry is partner's loan account debtor to bank account. Step 11, for final settlement of purchase consideration. So, after preparing the partner's capital account, the purchase consideration is settled or shared among the partners. The entry for sharing the purchase consideration is partner's capital account debtor to equity shares or preference shares account to debentures account to bank account. So, in total, the journal entries regarding sale of firm which has 11 stages. So it is a procedure we have to follow while preparing the journal entry. So likely the accounts to be prepared at the time of sale of partnership firm. One is realization account, the second one is partners capital account, and the third one is bank account or cash account, and the fourth one is the shares in purchasing company account, and the fifth one is the purchasing company account. So these five accounts are generally prepared at the time of sale of partnership firm. Thank you for hearing.